Hey everyone, welcome to the next episode of our Contra Investing Series where we look at businesses that are fundamentally strong but are currently going through a phase of disappointment. Either growth has slowed, narrative have changed, or market expectations have reset. In today's video, we'll talk about Medi Assist Healthcare Services. At the time of its IPO, Medi Assist was positioned as clean, scalable play on India's underpenetrated health insurance ecosystem. Asset-light business, strong parentage, leadership position among TPAs, that is third-party administrators, and a long runway due to rising insurance penetration. Basically, a proxy for growth in health insurance sector of India. It did well during the initial phase where its stock price jumped 65%. But that was also the peak of bull run. Since then, the broader Indian market has witnessed a brutal correction and Medi Assist stock has corrected 40% from the peak. So naturally, investors are confused. Is Medi Assist a fundamentally weak company? Can pricing pressure from insurers kill the TPA industry? Will in-house claim processing by insurers make TPAs irrelevant? Or is this simply a case of IPO expectations running ahead of fundamentals? What is interesting is the shareholding pattern. Since its IPO, promoter holding of the company has consistently reduced and today it is almost negligible. However, please note that the promoters were PE firm that invested long back and the selling is completely absorbed by FIs and DIs. FIs now hold 25% stake versus less than 10% during IPO and DIs now hold 50% stake versus 30%. Public holding has slightly increased during initial few quarters, but in last quarter it has reduced. And even number of shareholders have reduced from June 25 high. So weak hands have slowly exited during this correction phase and institutional investors have accumulated during this phase. As usual, we'll analyze Medi Assist using our 4-point contra investing framework and see whether it qualifies as a contra bet for 2026 or not. Alright, let's begin. Let's first understand the business model of the company. For that, we first need to understand where Medi Assist sits in the health insurance value chain. So Medi Assist is the largest TPA, that is third-party administrator in India with a market share of 36%. It does not underwrite insurance risk and it does not own hospitals. Its role is to act as an operational backbone between insurers, hospitals and policyholder. In simple terms, when you go to hospital for a cashless claim, Medi Assist helps you validate your policy coverage, coordinate with the hospital, processes the approvals, manages the documentation and finally settles the claim on behalf of the insurer. This may sound operational, but at scale it becomes a data-heavy, process-driven and a very mission-critical function. That's where Medi Assist add value. Insurance firm can focus on their core activity, that is insurance product development and underwriting. Hence, instead of building huge in-house teams, insurers rely on TPAs. For hospitals, the benefit is TPAs ensure that once the claim is approved, hospital gets their money from insurers. They don't have to deal separately with more than 20 insurance companies. Hence, it reduces the friction from hospital billing team and improves the patient's experience. And of course, patient does not have to pay upfront at network hospital, TPAs handle it. They don't need to run between the hospital and insurance company. TPAs does the coordination. Then another important point is claim management is not easy. Especially you need to do it efficiently and avoid all kind of frauds. And to do it at scale is extremely difficult. That's where Medi Assist adds value. It operates across retail health insurance, group insurance, that is corporate policy, and government-backed schemes. Although it is predominantly into the group insurance segment where it enjoys 32% market share with good growth in last few years. Basically, 32% of India's group health insurance premium is managed by Medi Assist. This segment contributes around 90% in company's total premium under management. Its individual insurance segment has small market share and the growth is also slow. Please note that Medi Assist does not take underwriting risk. That's with the insurance firm only. And that's what makes their business model asset light and capital efficient. Another important layer is data. Over years, Medi Assist has built large proprietary data sets around hospital billing patterns, treatment cost, fraud indicators, and claim behavior. This data improves the turnaround time, reduces the leakage for insurers, and increases the customer stickiness. We'll discuss it in detail shortly. Now, if you look at the downside of this TPA model, one of the downside is pricing power. TPAs negotiate fees with insurers, and insurers are extremely cost conscious, which means margins are structurally capped. So the business model is definitely asset light, low capital intensity, has got high transaction volume, but it has moderate margin and limited pricing power. Next, if we look at the management quality, please note that Medi Assist is a professionally run company. So there is no individual promoter. Before its listing in 24, it was mainly owned by PE firms, but now they have exited and today 75% stakes are with FIs and DIs. If you look at leadership team, Mr. Satish Gidugu is the CEO of the company. He is an alumnus of IIT Madras. He has been with the company since more than 12 years and has played a key role in making Medi Assist a leader in the sector. Before that, he was the CTO of Redbus. Overall, company's leadership has been focused on technology upgrades, hospital network expansion, and operational efficiency rather than chasing unrelated diversification. Governance standards are decent, disclosures are clean, and there have been no major red flags. Now, if you look at the balance sheet, Medi Assist had negligible borrowing till 2024. However, in 25 and 26, it acquired one of its competitor Paramount that was fourth largest TPA in terms of revenue. This deal was 312 crore and for that, company utilized its internal cash as well as borrowed money. Hence, its borrowing has increased. Although in the last con call, management has clarified that we expect to clear off approximately 150 crore of the current debt of 242 odd crores in the next 1 to 2 months time. In short, company has taken the debt to expand its business and overall it is in a financially comfortable position. Another important aspect is cash flow. Company generates exceptional cash from operation and has CFO to EBITDA of 80%. Return ratios have been decent. Company also has a healthy operating margin of more than 20%. Although its margin has dropped to 20%, but that's due to acquisition of Paramount that has a lower margin profile and there were integration expenses and other tech spend. Management has mentioned that their endeavor is to go back to 22 to 23% kind of steady state EBITDA in coming quarters. So if we conclude, is Medi Assist fundamentally a strong business? Answer is yes. It is a necessary, scalable, asset-light business operating in a structurally growing sector. But business strength alone is not enough. Let's understand the challenges or risk for the company. Now next question is, are the current issues temporary or permanent? To answer this, we need to understand why the stock price has underperformed in last few quarters. And the biggest issue is expectation. Medi Assist came to the market when insurance penetration and healthcare formulations were hot themes. The market extrapolated long-term growth too aggressively and assumed that operating leverage would kick in quickly. But post-listing, reality set in. First, pricing pressure from insurers intensified. Insurers constantly renegotiated TPS fee to protect their own margin. So this has limited the margin expansion despite volume growth. Second, there is a fear around insurers bringing claim processing in-house. So large insurers want greater control over data, fraud management and customer experience. And they want to rely less on TPS. This has raised concern on the growth opportunity of TPS. Third, growth in group insurance, which is a large part of Medi Assist business, tend to be a volume-driven, low-margin business. That diluted profitability expectation. All this resulted in earning growth that did not match the IPO era optimism. And when growth disappoints, valuation compress. It is clearly visible in the numbers where company's top-line growth has reduced from around 20% rate to below 20% now. Operating profits have remained flat in trailing 12 months, mainly due to fall in operating margin post-acquisition of Paramount. And since interest payment has increased due to borrowing, the net profit has compressed in trailing 12 months. The key question is, are these issues permanent? In my view, most of them are cyclical or expectation driven, not structural. Insurers may build partial in-house capability, but completely replacing TPS is not possible. Claim processing at scale is messy, operational heavy, and it requires deep hospital integration. Most insurers prefer a hybrid model rather than full ownership. Especially insurers prefer to opt for TPAs for group policy for corporate houses and like to handle individual insurance themselves. So the issues are real, but they don't break the business model. Next point of discussion is the long-term demand story intact? So India's health insurance penetration is still very low compared to global standard. This slide clearly shows how underpenetrated the health insurance market is in India. As income rise, awareness improve, and employer coverage expand, the number of insured lives will continue to grow. Especially the group insurance is expected to grow at faster rate as more young people enter into the corporate jobs. And today, more and more companies are becoming employee-centric and they're offering group health plans and various health and wellness benefits. So more insured life means more policies, more claims, and more need for efficient claim management. Then healthcare costs are rising at a fast rate. That increases the importance of fraud control, standardization, and data-driven claim processing, exactly where TPAs add value. So Medi Assist premium under management would grow from two drivers. First is increase in number of people opting for health insurance, and second is increasing cost of premium per insurance. Here I would like to specifically focus on the work Medi Assist is doing in the technology space. Basically, companies trying to move from just being a TPA to an HBA, that is Health Benefit Administrator. Earlier as TPA, they were mostly an administrator in the background that included approving or rejecting claims, settling hospital bills, and staying invisible to the end customer. Now Medi Assist sits closer to the user through digital apps like Maven, health cards, and portals where employees can track the claim, see their coverage, access wellness benefit, and even engage in preventing care. For large corporates, they are no longer just processing insurance, but managing the entire health benefit ecosystem, be it group policy, OPD, health checkups, wellness program. On the hospital side, they are actively negotiating packages, managing the networks, controlling the fraud, and improving service quality. And the real leverage comes from data. Today, Medi Assist has access to millions of people data that help them with deep visibility into the claim trends, disease pattern, hospital cost, utilization behavior, and fraud signals. This data helps insurers price the risk better, helps corporate design smarter wellness program, and helps hospitals improve efficiency. For instance, with advanced data analytics in FY25, Medi Assist detected 390 plus crore worth of insurance fraud. Another example is on user experience. So typically once the doctor approves the discharge, still patient end up spending 3 to 6 hours to walk out of the hospital. Today, Medi Assist has helped more than 2 lakh people to get discharged from the hospital within minutes of your doctor approval instead of 3 to 6 hours. So they are moving the business from being a low value admin to a strategic partner sitting at the center of the health insurance ecosystem. Now final question is, has valuation reset? Now this is where contra angle starts to emerge. Post IPO, Medi Assist was richly valued. Thanks to the bull run, its PE ratio touched levels of 60, price to sale was at 8 times, EV to EBITDA was at 30 times. But today, valuations are much more grounded. EV to EBITDA is at 17 times, price to sale is below 4, and price to earning is at 35. So valuations have fallen nearly 50%. Here you might argue that PE of 35 is still high, but please note that PE is not showing the right picture because of Paramount acquisition and integration cost that has resulted in fall in operating margin by nearly 200 to 300 basis points. Plus the debt taken to buy Paramount has resulted in higher interest payment. Hence net profits are depressed and PE is distorted. Valuation wise, I believe Medi Assist is now at much fair valuation. Going forward, market would keep a close eye on margin expansion and profit growth, and based on that, it will decide whether Medi Assist should get re-rating or not. But from here, I believe the downside is protected. Also, institutional behavior clearly suggests strong optimism. In fact, recently well-reputed FII MIT has taken stake in the company, and public holdings suggest that weak hands are exiting. Technically, the stock remains below key moving averages, indicating the market is still not convinced. Now, if we step back and look at Medi Assist objectively, the picture becomes clearer. This is not a broken business. It operates in a structurally growing healthcare and insurance ecosystem. Claim processing is a necessary function, and TPAs continue to play a relevant role despite industry noise. In fact, Medi Assist is investing significantly in technology and moving from TPA to HBA, that is Health Benefit Administrator, which is more strategic role. Overall, what has changed is expectations. Post-IPO optimism resulted in higher valuation, but after 40% correction, stock has become much more reasonable. At current levels, Medi Assist is worth keeping a close eye. The downside looks protected due to clean balance sheet and structural demand. But meaningful upside will require patience and consistent execution. And that's exactly what Contra Investing is about. Not buying perfect stories, but understanding what the market is currently disappointed about. and deciding whether that disappointment is temporary or permanent. Now you tell me in the comment, do you think Medi Assist is a good proxy for health insurance sector of India, or the business model is not very strong? If you find this video useful, do share it within your circle. I'll see you in the next video. Till then, take care.